given where the money may be going. Joining us now is Ohsung Kwon. He is Chief Equity Strategist at Wells Fargo. Ohsung, good to have you on set. Thank you for coming in.
Thanks for having me.
Small caps up, mini large cap tech stocks flat or even down this year. It's 11 days in. I don't want to make too much of it, but do you see a rotation happening in the equity markets?
Yeah, for sure. And I think this is going to continue for the foreseeable future. And what's really changed is we're seeing fiscal tailwinds for the first time in 3 years. And we have seen this movie before, right? Every December and into January, all the strategists come out and call for a rotation, and it lasts for like 2 months or so, and it sort of rotates back into AI. I do think this time is a little different, that we are seeing fiscal tailwinds for the first time in 3 years. Also, we started seeing a changing reaction function in the equity market. So over the past 3 years, higher rates meant the Mag 7 outperforming the Russell 2000. Now this is starting to change. And I think that's driven by two reasons. One is that the market's interpretation of higher rates is changing from higher rates are restrictive to cyclicals to higher rates are being driven by cyclical.
Let's start there. I want to get to the second part. I hate to interrupt, but I don't actually hate to interrupt. I interrupt all the time. But go back to that first point. Higher rates, good for the Mag 7. Connect the dots between higher interest rates and NVIDIA and others outperforming.
That used to be the case for the past 3 years. That's now starting to change. And I think one of the reasons is because a lot of these hyperscalers are issuing a lot of debt. So their sensitivity to rates are now changing. You know, just in Q4, the 4 big hyperscalers raised close to $100 billion just in Q4. So that's a significant amount of money, and their duration is also lengthening because of it, because their free cash flow is coming down because they're investing so much on CapEx. Their free cash flow margin is now going to be below the rest of the index. Their free cash flow conversion, so free cash flow versus net income, that's only going to be 50%.
So are you kind of, if I'm hearing you right then, the mega cap stocks, particularly the ones, not just the Mag 7, but I'm sure the other, you don't talk individual stocks, but companies that have issued a lot of debt to fund some of their dreams, are they kind of de facto bond market plays then? They're super interest rate sensitive?
They're becoming more interest rate sensitive for sure, and their duration risk, because they're spending so much money today for future returns, their duration risk has risen. And I think that's what's driving the change in reaction function in the equity market.
And so I think then the other side of your point, which I believe you were getting to, is that then the lower rates that we see, or steady rates, do they have to be lower, or can they just stay where they are for the smaller cap stocks to benefit?
I think steady works. I think the setup for small caps is pretty interesting this year. Now, I always say this. For small caps to outperform, you need speculation because the Russell 2 index these days, the makeup of it has changed a lot. There's a lot of speculative assets, such as quantum and a lot of small cap semi companies. But also, you need a good PMI. You need a good manufacturing cycle. And I think we are on the cusp of a potential manufacturing upcycle for the first time in 3 years.
Wow. And so take that out one step further then, Ohsung. What would that mean? What do people just buy the Russell 2000 and forget about it?
I still like the Russell 2000. I like the commodity side too. So like energy materials, we actually double upgraded both sectors from underweight to overweight back in November.
What does materials mean? That's a lot. That's a big category.
Yeah. So the metal side of things. So copper, even gold. I still like gold as well. I think
you've been early on that, and you've been right. But are you getting a little worried? It's getting a little crazy. I mean, silver has gone from 30 to what, 93 in a year. It's still a rock. It's a valuable rock, but it's a rock.
Yeah, I think we're just going through this huge debasement cycle right now, and I think that's likely to continue. We actually, based on regression, we found 3 drivers of the currency cycle, the fiat currency cycle versus hard currency. And those are fiscal deficit, debt to GDP, and inflation. All of which are probably going to remain negative for the foreseeable future. And what was also interesting is that we went back all the way to the 1800s, and we are in the 4th debasement cycle that started in 2022. And what
just the 4th since the 1800s.
Yeah.
That was a lot of hundreds ago.
It was, yeah. I mean, these currency cycles last a very long time. And what was also interesting was that every time there was a debasement cycle, the S&P 500 underperformed gold, which is happening right now. And I think that could potentially continue if the debasement cycle continues.
Then do I want to buy like the Japanese stock market's at a record or near a record? Do I just want to keep buying it then?
I think that's also, part of that happening is also being driven by debasement cycle. I mean, even the S&P 500 last year, I want to say a lot of that was due to FX. You know, S&P in euro terms last year was only up about 2.5%.
Yeah.
A lot of that was, you know, a lot of the gains that we saw in the S&P was due to FX, and gold obviously outperformed the S&P again last year. So I think we're still in the midst of this huge debasement cycle that's happening.